Your next guest says a new record could be coming. Tim Urbanowicz is Chief Investment Strategist at Innovator Capital Management. Tim, good to have you on set.
Great to be with you, Brian.
Man, we've been waiting for the small cap breakout for a long time. It's happened a little bit, but we're still not at a record high. Should we be bullish?
I think there are catalysts, Brian. And if you look at this and take a step back, we've had this valuation gap, small caps to large caps, for a long time. And that in and of itself is not a reason for small caps to break out. We need a catalyst to trigger that. We view that valuation as a spring that is compressing. The more that spring compresses, the more upside potential that we see. But right now, we look at the Fed potentially cutting rates. We view that as a catalyst to really help springboard small caps forward. You know, we've had the economic growth story, which is most important.
Yeah.
The rate cuts are where we need to be. Most debt that small cap companies have is floating rate. We think this provides some relief and could be the catalyst.
There's so many amazing companies in America. There's so many amazing people in America. But these companies and these management teams largely get ignored, Tim, because guess what? People they just say, oh, I'm going to buy NVIDIA and let it ride. NVIDIA, I think, as amazing as that company is, takes a little bit of the oxygen out of the small cap room.
It does. And look, I mean, Brian, we're of the mindset that trade is going to continue. Large cap tech is still a place you want to be. You look at the earnings momentum that we saw this last earnings season. It was very strong. We think that continues. We took a little bit of a breather over the last week. A lot of those names became overbought. But look, the AI infrastructure trade is still a place you want to be. Yeah. But we think small caps can catch up with the help of rate cuts.
You know what I think is probably one of the most interesting trends in the market, but maybe the most sort of not covered. If you've been bullish on Bitcoin, I know you have, a lot of people say, well, Bitcoin's going to kill gold, right? Bitcoin's going to kill fiat currencies. It might kill gold. Gold and Bitcoin continue to move higher. Are you surprised by that?
Well, Brian, I think it makes a lot of sense. I mean, you look at the fiscal situation in the U.S., all of the money that's being printed, the big, beautiful bill that is coming down the pipe. That's on top of $2 trillion in debt that we're already trying to service. So right now, especially when we see the Fed cutting rates into what we view as an economy that's still very strong, it's so important to find ways to inflation-proof your portfolio. And we think that's three things: things like gold, things like Bitcoin, and then also finding ways to get more equity exposure into your portfolio. Very important.
Vis-a-vis small caps, I assume.
That's a big piece of it. But, you know, large caps as well. And, you know, for a lot of the advisors we're talking with right now who are working with your retirees and pre-retirees, it's finding ways to cautiously increase that exposure. They don't want to necessarily take on more risk. That's why I think we're seeing this huge shift into risk-managed, options-based ETF strategies, buffered ETFs, floors, as a way to get more exposure, but still make.
There's a risk to that, though, Tim. Listen, you're a Chicago guy. You live outside of Chicago. That is the capital of the CTAs. That's the capital of options. That's the capital of I think, some of the smartest traders out there, but they're people that are willing to take big risks. How much risk should a non-CTA sitting in Chicago be taking?
Well, that's the beauty of the ETF market and all the evolutions that you've seen here over the past several years. A lot of ETFs have hit the market. In this options-based category, you can choose the risk tolerance that you want. If you want 15% protection on the S&P 500, there's a suite of ETFs that can give it to you. If you want a 10% floor, so on and so forth. There's so many different options, which really gives the advisors the choice of what is the appropriate risk tolerance for their clients and which.
Are they expensive?
So relative to the annuity world, they're lower cost. Relative to cheap beta ETFs, they're more expensive. Average cost of a buffer ETF in our lineup is about 79 basis points.